At the end of the presentation, we will all be on the line to answer any questions we receive from you during the webinar, so please type them into your console's Q&A window anytime during the session. You can also download the presentation materials using the resources window on the right side of our console. I'll now turn the call over to Charles Luke of City National Rockdale.
Great, thanks Rachel, and thanks everybody for joining. So we just had the last webinar about 3 weeks ago on January 31st. So we wanted to do a little bit of a different format today. So I'm gonna go through our overall outlook just really quickly. It's consistent with where we were last week or on the 31st. And then what I'm gonna do is dive into some questions that we've been getting from our clients that are relatively consistent across all of our different channels. So Rachel's gonna be getting involved in asking those questions in the Q&A format between sections. So to get started on our outlook here, we have 10 of our 20 speedometers in the green zone, and generally absent the majority of policy noise, and that can impact inflation and growth, which we'll spend a lot of time on today. We do think that the underlying fundamentals of the economy remain supportive of continued growth that is above trend. So you'll see on the next page with our forecast, we do expect 2 to 2.5% GDP this year, slightly below where we were in 2024. So we do see a slower pace of growth in 2025 versus last year. So risks have certainly increased, that policy may derail certain aspects of the economy, and we're watching that very closely. But I do want to be clear that right now we're operating in this vacuum relative to tariffs because of the way executive actions work and because of the unilateral authority that the Trump administration does have over proposing tariffs. So that's absent any other adjustments to policy. And because of the hyper focus on tariffs right now, we don't think there's enough focus on the overall policy mix and the different aspects that we could be seeing over the next year, such as deregulation and tax policy that will start to heat up in Q4. So that being said, we have taken a very hard look at some of the inflationary trends. We're still in the green on inflation. That overall trend does appear to be intact, and Paul's gonna walk through the most recent CPI and PPI reports. And tariffs can create a one-time jump. It's important to note that it's not consistent increases in overall price levels. It would be reflected in sort of a temporary hit, and we'd have to look at what happened to those trends after the adjustment occurred for tariffs. We also need to be focused on the consumer, so where sentiment is. And some of those trends are a bit worrisome, just as we've gotten into this policy uncertainty, but it still is very early stage, and we're pulling at strings to try to figure out the direction there. And again, Paul's gonna talk a little bit about that. So one positive development that we have seen with respect to the outlook in policy is the executive action that was taken on Tuesday night. It was titled, if you've gone through sort of the White House's releases, ensuring accountability for all agencies. So in this order, the Trump administration is taking aim at independent regulatory agencies, and those are those agencies that have operated under minimal presidential supervision. So what this is positive on is it's the first step toward deregulation that could help offset some of the impacts from increased tariffs. And if and only if the administration does intend to go all the way with Canada and Mexico and some of the other tariffs that they've proposed. And to address some of our negative or red speedometers, definitely a lot has come out on the geopolitical front about Russia and US negotiations over the past week. It's tough to work through the noise on those. It's definitely a very different approach than the last administration had taken. There is the potential for a summit between the US and Russia, and it does appear that diplomatic ties are being reestablished and embassies are being discussed as being staffed again. And this certainly has been met with criticism from Europe and from Ukraine. But if you sort of broad strokes step back and look at it from 30,000 feet, it is the first step and a potential end to the war in Ukraine. And no matter which way you slice it, that is a positive development overall for the geopolitical landscape. Further, if we just take a quick view at the Middle East, the ceasefire there has continued. It does remain a fluid situation, but in terms of where things stand, it's a positive development that has stayed in place. And then the other speedometer that's red is the S&P 500 valuations. We did see an all-time high yesterday of about 6147.5 to get specific. That occurred in intraday trading. And valuations do remain elevated, but so does corporate profit growth. So just a quick look at the Q4 earnings season so far. It's ahead of expectations by about 5%. 76% of companies have reported positive surprises. And then we're going to get the big one next week. I believe it's on the 26th. NVIDIA is going to be reporting. So if we move forward to our economic forecasts, our forecasts have not changed since we talked on January 31st. We have seen corporate profit growth moderate just a little bit, but it's still within our range of 10 to 14%. And we do expect interest rates to stay above 4%. And we don't think by the end of the year, the top end is going to be breached. So right now we're at about 4.49% overall on the 10-year. And the Fed is on hold. So we still like our 1 to 2 projection for interest rate cuts in 2025 at 3.75 to 4.25. And Paul will give us some insight on the Fed and Powell's testimony last week. So overall, when we bring it together, just to sum up our outlook, growth is still present. The consumer continues to spend, but we are looking hard at some of the inflationary trends that could occur from tariffs and any potential negative impacts that could happen on the growth side. We're about 300 points shy of our expectation for U.S. stocks to move above 6,400 by the end of this year, which would be in line with more normalized returns. And if you think about small cap positioning, they have struggled as of late with some of the volatility. But if we look past what's happening with the tariffs, the potential for deregulation, and the domestic focus of the administration, and then the evidence through manufacturing numbers that we actually saw last week is a big positive overall for the market. As far as the bond market, we do think rates are going to jump around a little bit, but generally they should trade between this 4 to 4.5% level on the 10-year Treasury. And we do expect it to be there by the end of the year. So it goes without saying, but policy decisions are going to dominate the headlines. The market is going to react to these headlines. So it's important for us to focus on the fundamentals and look beyond just the near-term impacts and try to establish a baseline for where we think the market's headed based upon what we see in the underlying economy. So I just will note that we are worried a little bit about sentiment and some of the impact that's happening and business decision-making. So we will be watching those components very closely. So to dive into the Q&A format, I'm going to hand it back to Rachel, and she's going to take us through the first question here.
Great, thank you. And I probably speak for all of the portfolio managers here that this is the question we're getting most frequently from advisors and clients recently. What do the new tariffs mean for the economy?
Great, thanks, Rachel. And it's certainly the elephant in the room, so let's jump right into it. But what we wanted to do was something a little different than I think what the headlines have talked about, which is just focused on a wide variety of impacts and really dive into exactly what the imports look like and how the relationships really are formed between the U.S. and its trading partners. And then I want to talk about, outside of just the effective tariffs, what's happening with a lot of the threatened tariffs, specifically on Mexico and Canada, because those have not gone into effect yet. So we're separating it really into two pieces. And we did want to give a balanced view of what the imports actually look like from the countries that have been mentioned, and then areas that we need to watch out for. And I think some of that may surprise you. But the first thing I wanted to do was level set, and that's that tariffs, if you look at the left-hand side, had been a feature of the economy going back to the Trump administration. So we all know the story behind the first tariffs that were implemented in March of 2018. But those did continue through the Biden administration, and they did increase under Biden. So you can look at the total amount of tariff revenue. And if you just look at the total, it's not fair because it's not prorated from 2018 to 2021 relative to Biden's full 4-year term. But if you actually look at the annualized averages, the Biden administration did collect about 25% more in overall tariff revenue relative to the Trump administration. So tariffs, in a sense, aren't new. The size of the tariffs, the scope, the speed, that's all new under the first days of the Trump administration. I also want to draw a stark contrast between the inflation rates that we saw in 2022 and tariffs, right? So those are very mutually exclusive. What we saw post-pandemic, if you look at the right-hand side here, was money supply expansion that was drastic, dramatic, and quick, and a huge pickup in consumption against very constrained supply. So we had a mismatch and an imbalance there that really drove the overall inflation. The impact of tariffs at that point was not driving that. So I just wanted to make that distinction. And so if we start with just steel and aluminum, which is the first effective tariff, what I wanted to do was just give you an idea of the market at a glance. So overall, if you look at the imports of steel and aluminum, it makes up less than 2% of the overall 3.6 trillion in imports that came into the U.S. And then through data provided by the Tax Foundation and the International Trade Administration, we do estimate the impact of these tariffs to be low. So in the top right-hand box here, you can see that this overall amount of imports represents less than 0.01% of GDP. And the growth impact in terms of the estimates from the information from the Tax Foundation is negligible. And the ultimate tariff revenue is small as well. It's just about $5 billion per year. So what we do start to worry about with steel and aluminum is the potential impact on global growth. So if non-US growth rates sort of start to slow, just because of the way that imports are flooding into the US, that will have an impact overall on the US growth rate. So when we think about steel and aluminum, we're really thinking about what the potential impact is to other countries and that follow-on sort of tertiary effect to the global economy. But right now, we think the impact on the US market from this is very low. And then just to dive in a little bit deeper on this part, if you look at this is aluminum sheet plate and foil manufacturing prices. So just how much it takes to make processed aluminum in the country, that's on the left-hand side. And then rolled steel shape manufacturing, which is just basically processing through steel. And so what you can really see here is that prices for both finished aluminum and steel did actually fall after the 2018 tariffs were imposed. And the overall longer-term 10-year inflation rates have been relatively mild. We certainly have seen those spikes, and we noted those based on the COVID-19 episode. But overall, for aluminum, it's advanced to just a 2% rate over 10 years and a 2.2% overall 10-year run rate for steel. And so prices have moderated substantially, even with the impact of the tariffs. And if you actually look at the overall result of the US market, production of US steel has not increased. It's actually fallen from about 97 tons in 2018 just to about 80 tons in 2024. So the market's in relative balance here. And again, going back to all of the statistics, it is a relatively small part of the overall import picture. And then the last comment I just want to make about steel, because we're always trying to figure out, what do we do in the portfolios when we see either an opportunity or a risk out there? And, one of the things that we took a look at was just how much of a market cap does both steel and aluminum companies really impact the overall US market. And it's very, very small. So if you look at the top 4 largest public steel companies, it's just about 69 billion in market cap. And the top 3 largest public aluminum companies, because there are only 3 above $1 billion market cap, is just a $13 billion market cap. So the overall impact to the market is relatively low. And the performance, again, going back about 10 years on steel and aluminum stocks has been relatively mixed. We've seen a little bit of an uptick here recently, just in response to the news, but we think that's sort of a near-term speculative reaction. We don't believe that that's sustainable. So that's where we sit in terms of what we think about steel and aluminum, which again is an effective tariff at this point. Let's shift over to China and the additional 10% tariff on China. So this is obviously much more meaningful than steel and aluminum. China does represent about 13% of all US imports, but there are a couple things to note about what those imports look like. First, I talked about the fact that tariffs on China were a feature of both administrations. And if you look at the right-hand side of the graph, you can see the US has reduced imports from China, and China has also made efforts to diversify the export-led economy that it runs by diversifying away its trading partners. But it's still a very large trade relationship, about 1.4% of overall US GDP. We do think the growth impact here is going to be relatively mild. I'll show you why on the next page, but it's still bigger than what we see with steel and aluminum. So it could be a growth impact of about a negative 0.1% level, which again still shows strong growth if you're thinking 2 to 2.5% on GDP this year. The employment impact here might be a little bit higher than what we see with steel and aluminum, but this is over a 10-year period. So you're talking about 7,000 jobs potentially per year. But the tariff revenue here is much bigger than what we can see from steel and aluminum. It's about 21 billion per year. So that is an additional contribution overall to basically US revenue. And so what we also need to do is look at what these primary imports are. So if you look at the left-hand side here, you can see where I've made the labels here. So radio and TV transmitters, computer data storage devices, parts and accessories for those data storage devices, rechargeable batteries. So let's take a look at some of those prices over the past 10 years. And basically the way to think about this is twofold. So a lot of the products that ship out of China don't represent unique intellectual property, and they're generally not patent protected. So in many cases, a lot of the Chinese goods that come in or anything you order on Amazon, right, they're copies of other goods. And then second, if we look at some of the biggest components of those imports, they've actually been on deflationary trends for about the past 10 years. So I don't want to make a personalization or sort of minimize the problem here, but I just bought a 65-inch TV from Costco for about $350 to watch Bloomberg TV in my home office. And so if you think about prices on electronics, they've been decreasing for a long time periods as adoption increases, as the technology is more broad and it filters through households. And those are really the largest imports from China. And then if you think at the other areas, the top right, the bottom left, and the bottom right, toys, computers, household equipment, those are examples as well. And so those prices tend to have deflation, again, as the market expands, as the products are learned, and they can be more easily manufactured and replicated. So when we talk about the tariffs that have gone into effect with China, there will be some pressure, but it is not likely to derail anything from an economic standpoint. And keep in mind too, if we switch away from imports from China, that goods and food really represent about 32% of the contribution to inflation. So the much bigger concern for us on a lot of these effective tariffs is actually services, which are not going to be governed by this. It's really just a goods-only mechanism. And if you think back to other times that we had tariffs, the US was more primarily a goods-based economy, and the global economy was more of a goods-based economy. So it impacted the numbers a lot more in terms of the flow through. So I'm going to stop there, and I'll hand it back to Rachel on the next question.
Great, thank you. And such good information about how to view the news about tariffs, potentially in a more balanced way. But what risks do you suggest the tariffs propose?
Yeah, so if we sort of broaden this out and take a look at some of the other components of tariffs and a lot of what's been threatened, we've got to start with Canada and Mexico. And again, I just want to emphasize this is what could happen. We don't know how the negotiations are going, and the effective date here is March 4th. So if we take the same sort of at-a-glance look at Canada and Mexico, Canadian imports and Mexican imports combined are about $866 billion into the US every year, which in terms of percentage of total imports is nearly 27%. So it is a big level coming into the country. And if you think about what's being imported here, and that's the most important component here, we've got autos, and so that's parts and finished autos, energy, manufacturing, and agricultural equipment. Once you get down below the top 10, keep in mind that those import impacts start to go down significantly, right? So the left-hand side here for Mexico, what you get outside of other motor vehicle body parts, you're starting to get below $8 billion in overall imports, which again starts to minimize the impact of those other imports. Same thing with Canada, right? You get through sort of the aluminum side, less than 5 billion, and those impacts are much, much lower. But if you use the overall data available, the percentage of US GDP that Canada and Mexico imports represent is about 1.4%. And that starts to translate into a potential growth drag of about 0.3%. So again, thinking about this year, our top end estimate, right, that still puts us in between the 2 and 2.5%, but it's a much bigger chunk. And then again, if we think about the estimated employment impact, this can be about 27,000 jobs per year. So it starts to go up. What also goes up is the tariff revenue, right? So about $88 billion in overall tariff revenue, which again is positive based on the desire for tax cuts and some other aims of the administration. But I want to clarify, if you notice some of the inflationary aspects that grab the headlines, so things like eggs, they're much less impacted by the overall targeted countries. It's not in the top 10. And like most importantly here, what I want everybody to focus on is agriculture really isn't even present here other than some of the machinery provided, like tractors and things of that nature. And so just to take eggs as an example, in 2022, the US exported about 261 million cases of eggs. They imported about $110 million worth of eggs, right? So there's a lot of domestic manufacturing, and a lot of the food prices are being impacted by things that have absolutely nothing to do with tariffs, but they do grab those headlines. And so where I think we really need to be concerned with Canada and Mexico is on intermediary goods. Auto supply chains suffering particularly acutely. So if you look at the peak in Ford stock going back to 2021, it's down about 64%. Since the tariff announcements during our last call on January 31st, it's down about 10%. GM is down about 30% from the 2021 peak. Since 131, it's down about 8.6. And the automotive component overall of the S&P 500 is down about 12%. So I think that's the most directly impacted market that we can find at this point. And it certainly, again, indicates those intermediary goods, those indirect goods that are being imported as part of sort of final finished goods. So what is this going to do to inflation? Let's kind of shift the conversation there. And I wanted to sort of break down the influence of imports on the overall measure of personal consumption, which we call the PCE. So there's a great study and a good methodology that's relatively new from the Federal Reserve Bank of Boston, and they put this forward here just recently. But what their conclusions are is that between direct imports, and those are essentially finished goods, versus indirect imports, which are the supply chains, I talked about those intermediary goods, what's the influence on inflation? And it accounts for about 10% of the overall makeup of the inflationary numbers. So that was surprising to me, right? I think we expect that the import market is going to impact inflation numbers more than that, but it's really just 10% of the contribution. Everything else is really coming domestically and internally. So where we see the biggest impact on the contribution to inflation is what's happening in pharmaceuticals and on the medical side, things like garments, video equipment, recreation. So some of those are covered in the imports from Canada, Mexico, and China, but noticeably what's missing is the pharmaceutical and medical side, which is the biggest component. Now, we may start to see some tariffs come in, and we'll talk about that when I highlight some of the other threats. But right now, that's not on the table in terms of a lot of these tariffs that could go into effect. So the biggest component and the biggest influence on inflation isn't really there and present yet. And so if we use this calculation, a 10% impact on personal consumption, let's look at the inflationary and some of the GDP impacts we could expect. So if we go there, the combined impact of Canada, Mexico, and China tariffs would have the potential to add, as a one-time step up, in the middle bar on the left-hand side, right? About 0.5 to 0.8% on the overall level of inflation. So think inflation printing for a temporary period at somewhere around 3.5%. And then GDP overall could take about a 0.3% hit. And what I've done here on the right-hand side is I've taken the Fed's expectations based on their summary of economic projections for what I'm using for GDP. And then I've taken 3% off the top there. So what potentially this could do if everything were to go into effect as stated, it could take GDP back into its sort of long run frame in terms of where we're running right at potential. But I do want to bring it back to, keep in mind this is happening in a vacuum. So it doesn't take deregulation, tax cuts, or other elements into account. And also keep in mind this is a one-time adjustment. So we would expect to see this jump in costs followed by a resumption of the current trend, especially when we compare inflation rates month over month and we're looking at it in the very near term. So taken in isolation, this does concern us about the potential for equity returns and higher yields, but it's not in effect yet. And we don't know how it's ultimately going to hit the market. So we have to be vigilant, but we're not looking to make a ton of changes in the overall asset allocation right now. It's more important to focus on sector specific, which I'll talk through in just a second. And it's also important to remember that there were a variety of deals that happened under the 2018 tariffs. So there were exemptions that were given out. And at the end of the day, we do think this is about an 80% negotiating tool and a 20% focus on revenue. So the Trump administration is trying to extract policy objectives from these countries, and negotiation's a big part of it. So what I also wanted to do was sort of break this down into supply chain, first for tech, because I think that's important as such a big overall part of the S&P 500, and then we'll take a look at some of the sectors. But if you look at the Mag 7 supply chain, if we talk about China and Canada, it's about a 14% exposure if you break down the 20 top suppliers. And essentially there's no exposure to Mexico. So overall, the impact of the supply chains in the tech sector is going to be pretty low. There's several factors that are impacting that sector way outside of just supply chains. But when we think about the impact of tariffs, it's not a bad place to be. And if we start to compare sort of tech sectors and other sectors that have rallied after January 31st, it's really not rocket science to figure out where the market is responding. And that is in information technologies, given the insensitivity, and also in the energy market. You can see it in areas like materials, utilities, real estate, and then staples as well. And again, those are some of the more domestic focused sectors. But keep in mind as well that for these sectors, if you're positioning in the very near term, all of these different components, whether it's tariff rates, specific countries, potential exemptions, they can all create major swings. So it's difficult to try to pinpoint exactly where to position, but there are some of these longer term trends that we do think will benefit under the Trump administration. So just to sort of wrap that up, I don't think you can count on anything until we know what the actual imposition of these tariffs is going to be. We'll know more about that with Canada and Mexico on March 4th. And so to sum up this sort of process and conversation around tariffs, I know it's not just limited to Canada, Mexico, and China, right? We do have other tariffs that have sort of introduced themselves and been threatened. So reciprocal tariffs, we have very little information. There's no scope, there's no date certain of when they'll be imposed. But again, I think it's being used as a negotiation tool, and that is bringing other countries to the table. Just quickly with the BRICS, there was a threat of tariffs there, and the BRICS are basically a consortium of countries that have gotten together to sort of establish a new monetary standard and potentially bring up some other currencies. So it is a potential threat to the overall US dollar dominance, but it hasn't taken a clip out of it yet. But there was a threat from Trump that there could be a 100% tariff on those countries if they didn't transact in US dollars. EU tariffs have been threatened in a few different ways. Right now, they're sort of translating through autos. And that's another one where we're seeing a 25% threatened tariff on autos of about 25%, semiconductors at 25%, and then pharmaceutical at 25%. So we'll see how that filters through. But as far as country specific, I think product specific are a little bit easier to digest. I'm hopeful that the country, I wouldn't say attacks, but I think the unilateral country engagement starts to decrease a little bit as we get further removed from the inauguration. So that's where we are on the tariff picture. I'm going to stop there, hand it back to Rachel, and Paul's going to go through some of the impacts to the economy.
Great, thank you. And we've had a handful of questions come through the Q&A box, and we'll be turning our attention here. So Paul, what does the recent data say about the state of the economy?
Yeah, it's been quite interesting in the aspect that we've had in the past few weeks. We've had data that has really taken the financial markets on a bit of a roller coaster ride. Last week, we had CPI that came in much stronger than the market's expectations. And of course, that pushed the fear that the Fed might not make any cuts to interest rates this year. Then the next day, the the retail sales report came out that was much weaker, and that reversed most of that. But what's interesting about all this information is the impact that it's having on the consumer. In this chart here, we're taking a look at the two major metrics in terms of measuring consumer confidence or sentiment. And you can see in the last few months, both of them have been on a bit of a downward trend. And the reason being is just the uncertainty that lies out there, not just in the financial markets, but what's coming out of Washington. You have the threats of tariffs, and then they get delayed for 30 days or so to be reappraised. The stock market swings, of course, and it's even getting harder to find a job. So this is weighing on many consumers who are looking for some sort of stability once the election was over, and they're not exactly getting it. The impact has even gone a little bit further into some sectors of the economy, most notably the housing sector. The chart here on the left is a survey that's done of home builders. This is a diffusion index, so anytime a number comes below 50, that means a contraction. Anytime it's above 50, means an expansion of some sort. And you can see the shaded area is the overall index, but when you look at the three major components, every one of them is below 50. Most notable is the dark blue line in terms of future sales. So home builders are concerned because they do import an awful lot of goods to help build a house. It's not the majority of it, but 70% of the wood used to build a home comes from Canada. 70% of the gypsum that's used for sheetrock comes from Mexico. So this is a big concern. And you can see over on the right-hand side, the correlation between this index and new homes that are being sold. So it is a concern for this sector. Now, both of these, the consumer sentiment and confidence on the previous page and these aren't really big worries for us right now. Consumer sentiment and confidence since the pandemic has been in the doldrums, yet consumer spending has been extraordinarily robust. It's been the driving force of economic growth in this expansion. So that's not much of a worry for us. And housing, we weren't expecting much out of the housing sector in terms of a growth engine for the economy anyway. Home prices are very expensive, mortgage rates are still very high, and we are at a later stage of the business cycle. So that has not been much of a concern. What we've been looking at more in greater detail really is what businesses are doing and what they're thinking. Now, this data here is on small businesses. Small businesses are defined as roughly 250 workers or less. They employ about 80% of the workforce. So it's important to know what they're thinking, and they're extraordinarily excited. The chart on the left-hand side just shows overall optimism, and you can see how that has skyrocketed in the last 2 months. Their view of the world is much, much better. But more importantly, are they going to be spending more money to expand the businesses? And we can see that on the right-hand side. Yes, they are. Now, do keep in mind that this cohort does tend to be very conservative. So the idea of tax cuts and deregulations, they find euphoric. But this is what they're thinking in terms of the future, and it's very important to know. In terms of the manufacturing sector, this is another issue that's quite important. On the left-hand side is the ISM Purchasing Managers Index. And this group goes out and surveys purchasing managers at manufacturers because they're really going to tell us what's going on. Economists love this number. First of all, it comes out on the first day of the month. But the data has been around since the late 1940s, so you can make a lot of comparisons to past business cycles, which is very helpful. And the manufacturing sector is far more cyclical than the service sector. So when you start seeing changes here, we're going to start knowing that we'll probably see some changes going on in the overall economy. But again, you can see here, this is a diffusion index, and it just popped up above 50. Purchasing managers are getting a little bit more excited about the future. It had been very strong. You can see on the chart on the left-hand side during the pandemic, it rose as many people bought an awful lot of goods. Even though the vaccine came out and people shifted spending towards services, it still stayed high as a lot of businesses had to deal with trying to replenish a lot of lost inventory. But it dropped quickly as interest rates started to move up, and by and large, for 2 to 3 years, has been below 50. The chart on the right takes a look at the details, and this is the exciting part in terms of what's driving this growth. And you can see that the biggest issues that are going on here is the light blue, new orders. That's a great leading indicator. Production is also very, very strong, and supplier deliveries. So these are great leading indicators in terms of the manufacturing sector, which of course is important because this is the sector that will benefit most from tariffs if they're imposed. More importantly, it's broadening out. They look at 18 different industries. On the left-hand side, you can see how that's started to move up. And that's, again, a way of knowing that we're seeing some more strength that will probably continue, that this might not be a one-shot deal. And in terms of the production, you can see that over on the right-hand side where that jumped up this past month. Because this is starting to be where the rubber hits the road. Means that they will have to hire more people into the sector. In terms of the confidence of CEOs, this too has also moved up. And this is also important because this is where the decision-making goes in terms of spending, especially in terms of CapEx, which is on this chart here. You can see that has also moved up in terms of the expectation going forward. So these are all signals that are telling us that the economy looks like it's going to grow at a little faster pace. But keep in mind, this is survey data. This is what economists refer to as soft data. The best analogy I have for the difference between soft data and hard data is, on Friday evening when I asked my 2 teenage sons what their homework plans are for the weekend, that's soft data. Sunday night, when they tell me what they actually did, that's hard data. And I'm sure it doesn't surprise anyone on this call that sometimes there's a big difference between those two. That's what we're going to be looking at to try and figure out at what point does this start turning into hard data? When does manufacturing start hiring more people? That sort of thing. But the important part here is the fact that we're seeing upward momentum in the manufacturing sector, which is one of the driving forces of what this administration wants to accomplish.
I think we all know a little bit about the difference between that soft and hard data. But on that note, and inflation, why did CPI spike in January? Why did retail sales decline?
Yeah, it's a little weird. We're starting to see some developments of some seasonalities that are not being addressed in the seasonal adjustments of the data. In terms of the CPI data, the chart here on the left, the columns are showing the monthly change, and the line is the year-over-year change. And there's a couple of interesting issues that are going on right now. First of all, if you look at the far right side of the left chart, you can see that the trend on the monthly data has increased. It was up 0.4% in January, 0.4% in December, 0.3% in November. It's not a trend that the Fed wants to see. The average for the last year was a little bit over 0.2%, so it's way out of the range. If you look at the dark gray line on the right side of that chart, that's what the Fed wants it to be, because a reading of 0.165 works out to be an annual rate of 2%. So just under 0.2% each month. That's what they're looking for. But it's interesting. You can see this January was a high number. Last January was a high number. The January was before. And what's happening is we're seeing an awful lot of attempts by businesses to try to increase the pricing that they have, whether it's insurance or whatever it may be. And so you see the big jump. And the purpose here is really to try to increase their profit margin, to try and offset losses of the profit margin gains that they had the previous year as their expenses went up. We didn't see this before the pandemic because remember, inflation was running around 1 to 2%. It was much lower. But now businesses know that they have a good chance of being able to push through price increases because people have seen that. And in the past few years, and as a result, with a strong economy, low unemployment rate, they're more apt to pay again. So that's something that's starting to kick in. And because the way the seasonal adjustments work, it goes back, depending on who the agency is, anywhere from 5 to 10 years and makes adjustments to that data from that. It really hasn't kicked in, so we're not seeing the adjustments here, just like what we saw right after the pandemic. But you can see that over on the right-hand side where we're looking at the monthly change for each one of the major components of the CPI report. In terms of transportation services, well, that's like cars and wages have moved up, and also gasoline costs have moved up. Recreational services, you see adjustments in health club and country club prices moving up. Medical goods, that one I'm not too sure about. We haven't found much information on that, but energy, of course, has nothing to do with any of that. That's separate. Vehicle parts and equipment, those all moved up because the expense of fixing cars has moved up. And that's become very important because used car prices have moved up. So people are fixing up their cars to be able to sell them. These are all seasonal things. Last year, if you recall, the Fed was expected to lower interest rates in the first quarter, but high inflation prevented them from doing so. They had to wait until the late summer. So we're not sure whether this is a seasonal thing or not, but it is something that we're watching very, very closely. Another thing that's going on with inflation is where we're starting to see price movement. The chart on the left just breaks it down into the two major components, and the dark blue is goods, and the light blue or the bright blue is services. Goods prices, of course, shot up because people were at home buying stuff to keep the family occupied during the pandemic. And as soon as we had a vaccine and people started to buy services again, those prices plummeted. And that's what was the driving force in bringing inflation down. The light blue services, that came down at a much slower pace. But now you can see goods prices are starting to move up on a year-over-year basis. And that's not helping out the inflation scenario. And this is a concern when you look at the major categories of inflation. On the right-hand side, the light blue column that you see there, that's the year-over-year change in inflation. The dark blue is the last 3 months annualized, so you can make for easy comparison. So although inflation CPI is measured at 3% year over year, for the last 3 months, the annual rate is about 50% higher than that at 4.5%. And you're seeing changes going on where we didn't see that beforehand. Food prices are moving up. It's not just egg prices, but it's also other aspects in terms of like pork prices are up quite a bit. Energy prices, of course, have gone up significantly. But what's interesting is the services, shelter and services without shelter, those are starting to stabilize. And that's a very good sign because that's about 2/3 of people's spending, and that will help bring down overall inflation, all else being equal. But the goods prices, that's a bit of a shock, most notably with the energy prices. In terms of spending, the left-hand chart, the column is just showing the monthly change, and you can see it's a pretty significant decline that we saw there. But the few months beforehand were extremely strong. The feeling here is that people loaded up in the fourth quarter of last year on a lot of products that they thought might be tariffed, and they did not want to have to pay the higher price. So they pulled forward an awful lot of purchases that they would not make, and it's a bit of a reversal of that. And that might very well be the reason for the sharp decline of what we're seeing. And again, you can see that in the chart on the right, where we're taking a look at the monthly change in terms of those sectors that had the biggest decline in buying, that those might be products that might be tariffed. But the issue that we have regarding the consumer is that it's on a very healthy path. The fundamentals are extraordinarily strong. The chart on the left just shows the trend in retail sales. You can see for the 5 years before the pandemic, it was pretty linear movement. And then since the pandemic recession, it has shot up quite a bit, but continues on that same sort of trajectory. And we don't see anything interrupting that. Again, the unemployment rate is extremely low, but more importantly, people's disposable income. The chart on the right is just taking a look at the income that households are receiving after inflation. And you can see that's relatively stable in terms of its growth. And this is what's going to keep consumption as a driving force of the economy going forward. So we don't see much interruption as a result of these numbers that just recently came out.
And to follow up on that, these inflation points and all that you went over, what's the latest thinking? What's the latest on the Federal Reserve's thinking?
Simply put, the labor market is strong, so they don't see a need to lower interest rates for that. And the inflation rate is a little higher than what they want, so they see no reason to ease in the near term. So in terms of our outlook for at least the near future is that we probably won't see any actions by the Fed in terms of interest rate movements. We do know that they plan to cut interest rates by 50 basis points this year. That's what they tell us. They don't tell us when it will happen. They just say it will happen by year end. But the chart on the left and the chart on the right, both of them are signaling almost but no cigar. The payroll number that you see on the left-hand side, I mean, it did come down from levels that are not sustainable to much more reasonable levels like what we saw before the pandemic. You can see that by the dashed line there. The weakness that you saw during the summer, where it moved below the dashed line, that's when the Fed was forced to start lowering interest rates. And they started off with a 50 basis point cut in September. But payroll growth has started to move back up again. So the Fed can hold off a little bit. In terms of inflation, the same sort of thing. It's stabilized. It's about the same level it was 6 months ago, same as what it was a year ago. It's not moving up severely at this stage. We don't expect it to. So the Fed can really sit on the sidelines as they watch and see how the economy reacts to the interest rate movements that they've already put into place, since there is always a lag that's going on. But the other thing to keep in mind in terms of the whole inflation fear is that the inflation number that the Fed cares about is PCE, or the core PCE number. We put in the core PCE number because that way we don't have to sit and explain volatility of oil prices, which the Fed doesn't tend to pay much attention to. But you can see right now in terms of the core PCE numbers that it's at 2.8%. The Fed does not expect inflation to be at 2% right away, or this year, or next year. It's a couple of years away. They're expecting it to end the year at 2.5%. So they're not off the mark very much, just 0.3%. In terms of the market's expectations, you can see that here on the right-hand side. The first cut right now is not planned until September. And actually, the market hasn't fully priced in a cut by December of this year. It's close, but not fully pricing in that. I'm sorry, they're not pricing in that second cut for this year. It probably won't be something that we'll see until next year. But this is an extremely volatile metric, and it moves around a lot. But it's also consistent with what our view has been since pretty much the early autumn, and that the Fed has one or maybe two cuts planned for this year.
Great, thank you. And monitoring the Q&A questions, we've actually gotten a handful on this, so those of you listening, I think this will be interesting to you. But the U.S. federal debt and deficits are large and getting larger. What is CNR's take?
Yeah, seriously, this must be 2 out of 3 questions I get deal with either what the deficit is for this year or what the total debt is going to be. The basic issue here is that the federal government spends an awful lot of money, and they do so in various ways. The administration has taken on wanting to reduce the amount of government spending that's going on. But at the same time, we're also proposing some issues that could raise it even more. This chart here just shows the major sectors in terms of where the federal government spends money. It takes a look at what it was in 2019, 5 years ago, what it was before the pandemic. So there was nothing special that needed extra money to be spent on. We weren't in a recession. There wasn't a pandemic going on. And the same thing is true about 2024. There was nothing overly special that would require excess spending going on. And also what the CBO thinks is going to be in 10 years from now. The thing is in the last 5 years, they've increased spending by more than 50%, and they expect to increase spending by another 50% over the next 10 years. And this is a basic problem. If you look at the components that you see there, where do you see the big growth happening? Well, it's happening in areas that really deal with the fact that we have a very aging population. Social Security, Medicare, Medicaid, income security is also another thing. These are all areas that have nothing to do really with the economy. It just has to do with the demographics of what's going on here. So spending is a big issue, and this is why the administration is talking about areas to try and make government far more efficient to help and bring down some of that cost. But that's pretty trivial in terms of where the spending goes on. If they want to deal with the overall debt or the deficit in each year, they really have to tackle Medicare, Medicaid, and also the Social Security issue. That's where you're going to see the big changes that need to take place. Now, the new Secretary of the Treasury has put forth this plan of 3-3-3, and the goal here is that the annual deficit be 3% of GDP, which would equal the growth rate that he expects of 3%. So that means the debt to GDP ratio would not grow. And the easiest way to get about that is to increase oil production by 3 million barrels per day. On the left-hand side, just shows the deficit to GDP. The blue is history. The gray is what the CBO is expecting going forward. And because of the larger deficit and because of higher interest rates, this has grown quite rapidly. And as you can see, the deficit to GDP is circling around levels that are extremely high, much higher than what we had seen in the past. Interest alone is at roughly 3%. So this is a bit of a problem because overall it's 6% and interest is only 3%. It's going to be pretty hard to bring the deficit down to just 3%. In terms of oil production, on the top right chart that you can see there, well, oil production is at record highs right now. In fact, from the pandemic, the United States is the only major source that has increased production. OPEC has decreased it a little bit, and the rest of the world is about the same level it was beforehand. Higher production, usually, in a capitalistic society like what we have, they're going to want to see higher prices to want to do so. And that's not consistent with growing an economy. So this is a tricky one. Plus, the cheap oil that we've been able to get out of the ground from fracking is sort of gone by the sidelines. We don't have an awful lot of small oil companies that have gone around looking for this. We just now have bigger oil companies that want to pay down debt and increase dividends. So that one's a bit of a tricky thing to do. And then, of course, the bottom right that you see here, in terms of GDP growth, you can see the long-term history of that. The long-term history is that GDP growth has been a little bit more than 3%, but it is not something that we've seen of late. So it's going to be tough to see that level of growth. So it's not going to be an easy thing to accomplish. The other issue that he's talked about is in terms of bringing down longer-term interest rates. They've made the statement that when they talk about bringing interest rates down, it's not so much federal funds rate, but longer-term interest rates. And of course, that makes sense because longer interest rates are important for an awful lot of borrowing, whether it's a mortgage for a household or whether it's the corporate sector or just general bank lending. Longer-term interest rates are more important. One way to do that is to restructure how the Treasury issues the amount of debt that they have. On the left-hand side just shows the weighted average maturity of the debt that's outstanding. And you can see from 2010 forward, they increased that pretty significantly. And the main reason was that interest rates were extraordinarily low. Let's lock that in. The pandemic changed things in that there's a lot of bill issuance to help finance an awful lot of the spending, and it's sort of gone back onto that trajectory. Over on the right-hand side just gives you a breakdown, just to give you an idea of how the money is issued in terms of debt. That a big chunk of it is in either Treasury bills or Treasury notes, which goes out to 10 years. Bonds, which are 10 to 30 years, is also a smaller share there. But the biggest issue here is that's not really the main issue in terms of determining longer-term interest rates, the supply. On average, longer-term issuance accounts for roughly 10% of the amount of debt that's out there. It's extremely small, so altering it won't have a bigger impact. And this chart here just gives you an example of the fact that it's really market dynamics that determine longer-term rates much more than the supply issue, because they can't alter the supply because there's just so much supply out there. The shaded area here is the size of the Fed's balance sheet. And as you see, with the pandemic, it was roughly $4.2 trillion in size. And they basically more than doubled it. During the pandemic, they took an awful lot of bonds out of the market, roughly $4.5 trillion worth of bonds out of the market. Throughout the yield curve, some of these were mortgages, but it's an awful lot of supply that came out. But look what happened. I mean, interest rates still moved up over that period of time. Why? Well, they had moved down beforehand because the economy was weakening as a result of the trade war that was going on. The pandemic hit, and all of a sudden, growth looked stronger and stronger with all the fiscal and monetary stimulus that we had. That's what pushed up interest rates. So supply by itself is not enough to push interest rates. The Secretary of the Treasury, really smart man, and the president both have an awful lot of power to help try and push that down with conversations that they have. But supply by itself is not going to do the trick. And we still have one final issue that we have to deal with this year, and that's the debt ceiling. We've already hit the debt ceiling. We hit it back in January. They're using extraordinary tactics to try and be able to pay bills. They're in pretty good shape in the aspect you can see here on the right-hand side that the cash balance is quite high, of around $800 billion or so. That's an awful lot of money. Plus, they'll get more money in April when people start paying their taxes. So the X date, or the time that they absolutely will run out of money and have no other options, is estimated to be somewhere between June and August of this year. And this gives Congress plenty of time to be able to plan for that. So hopefully that won't be the big news that it has been in the past decade or so.
Great. Thank you, Paul. So turning to a new topic here, going back to Charles, gold has been rising substantially. What's going on there?
Sure. Thanks, Rachel. And this is a question that's come up in the Q&A box a lot too. So I'm glad we've got it here in the content. But what is behind this movement? So I think we've all seen gold prices have run substantially. But what I'm concerned about, and we talked about this really at the end of last year, is the typical underlying reasons for the run really aren't present. So inflation isn't really thrusting higher, right? It's at 3%. It's higher than normal, but it's not at 8%. That tends to force a run up in gold. And the second item is that the dollar is strong. So what we really have to do here, because those historical reasons are present, is really look at the market dynamics. So there is a lot of speculation that the US Treasury, which does value current gold reserves at about $40, will actually revalue their gold holdings. And this is associated with the executive order to create a sovereign wealth fund. But while that's an interesting idea, it's pure speculation. And actually this morning, Treasury Secretary Bessent did throw cold water on that idea. So a lot of people started interpreting that from his comments last week but he sort of walked that back this week, and it doesn't appear that that's on his radar. And so what we're actually seeing happen is that paper gold markets, so when you hear futures, basically traders trading gold for delivery, a lot of those paper markets are now demanding delivery. So that increased the demand for physical gold. And as you can see from the charts on the left-hand side, these are silver and gold inventories. They've spiked substantially here at the beginning of 2025. And if you look at the right-hand side, the demand for physical gold is actually at its highest since the pandemic. But we're also seeing an increase of physical gold actually flowing into the US. And just kind of looking at US flows amongst everything else, it also matches off against all of the increased US equity flows that we're seeing. And so that's just another component, just the amount of wealth flowing into the US that's helping to drive our markets. And so that flow continues despite some concerns to the contrary. And then if we actually look at prices here, gold has traditionally been a good hedge against a weaker US dollar. And at times on the left-hand side here, you can see that it's outpaced the return of the S&P, but it has underperformed stocks over the longer term. What I'm really concerned about for a position today in gold is the chart on the right. So given the typical drivers of gold prices really aren't present, the correlation between gold and the US dollar now is very elevated. And that likely means that we're due for a readjustment. So based on the Fed being on hold and higher US rates relative to global levels, I do believe that gold is at risk because of some of the speculation and trading of dropping here. So if there were a significant pullback in gold and the outlook for inflation and the US dollar potentially are at risk, we certainly would consider adding a potential position, but we don't think we're at that point at this time. So back to you, Rachel, for the last question.
Great, thank you. And again, another item that's come up in the chat, non-US developed markets, especially Europe, have been moving higher. Why is that?
Yeah, so this is a great question. And I think if you look at the market returns on the left-hand side here, they have moved dramatically outside of the US. So the Eurozone's outpacing the S&P by about 7.6% in just 45 days. One of the things that's interesting about this is the German market has spiked significantly, but there's a major German election on Sunday. So this reminds me a lot of what happened over last summer with Mexico and France. But that economy is also contracting. It's also in the middle of an energy crisis triggered by a lot of this Russian gas reliance that Europe had. So it's really juxtaposed in terms of this movement and the underlying economic stance. So what we do think is driving a lot of this rally is the Trump administration goal of getting Europe to start contributing more to defense. And you can see in the underlying sector exposures that the defense stocks have really jumped substantially, up nearly about 20%. So that's driving a lot of this market move. And then we're also actually starting to see earnings come in a little better than expected in Europe, but they're still extremely low. So the expectation for Q4 was about down 1.3%, but it came in at about 0.8%. So, you compare that to the US coming in at about 12%. The earnings comparison really just isn't even close when it comes to European markets and US markets. And then I do think the rise in defense stocks is speculative. And so we need to go back to our core reasons for international investing. And we're not looking for 45-day periods. We're looking for long-term secular 10-year trends to make these allocations. And if you look at international investing, 3 conditions. We got to have growth. We don't have growth right now. We've got to have currency stability. The dollar continues to strengthen. We do see world currencies move against that and go down a little bit. And then there's also the geopolitical consideration. So while some dynamics there you could argue, are getting a little bit better, the geography of a lot of these international developed markets, as well as the situations, we don't think is creating a stable environment. And then the other component is just technical. So the climb in European markets really hasn't matched up with the EPS, the earnings per share estimates. So in order to justify these valuations, the measures that I've seen is that Europe would need to shift into a double-digit growth type of scenario like the US to be able to sustain these levels. So again, I just want to go back to the comment that we're really not positioning for these 45-day moves. We're looking for the trend to be sustainable. And we do worry at this point, based on the run, about a reversal in international stocks, especially given all of the US potential policy impacts that could be a drag on global growth. So back to you, Rachel.
Great, thank you. And we are out of time here. I think we did cover the majority of questions that came through the console. For those of you who didn't get your question answer, of course, please reach out to your portfolio manager or senior investment consultant who'd be happy to address more specifics. But thank you all for joining us. A brief survey will pop up shortly in your console. So please share your feedback and suggestions for future topics. We read through all of those and we discuss them as we plan for upcoming webinars. A replay of this session will be available within 24 hours, and you'll receive an email letting you know how to access it. Have a great day, everyone.